Hello and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
Good. We're getting close to the end of the year, 2 months or so left to go. It's officially curling season for me, which is really exciting. So it's the race to the end, I guess.
Yeah, and the kayaks are out of the water up here in Michigan. That is for sure. So, but yeah, that the red hot fire market from summer is also fading away, just as the kayak season is, right? So a lot changing, but in the real estate side, in our area is at least making a lot more buying opportunities than there were with the super low inventory and high competition of the summer. Is that what you're seeing too?
Yeah, we're starting to see that for sure. I think that inventory is still low, but the market itself is not nearly as crazy as it was. There aren't nearly as many buyers, or they're buying in a different way, so it's making it a little bit easier, which is nice.
Yeah, and that is helpful again for those end of year goals, end of year planning, all that kind of complexity that exists. Yeah, hopefully some less competition, some ability to jump into the market is helpful.
And speaking of the end of the year, one of the things that I always start to worry about as I get toward the end of the year is the tax season stuff, right? The tax picture as we get toward the end. Most real estate investors, I think, it's like scheduling your dentist appointment, right? Like you know you should do it, but you don't really want to start talking about it. And that's kind of how we approach tax for the most part.
Yeah, I think that's very common among real estate investors to just be intimidated by taxes and to just hesitate about that whole thing, or just to gloss over tax questions and move past. But I'm continually impressed when I talk with investors that have gotten to that level of sophistication where they have some tax strategy to what they're doing, and the value and the return that there can be by just being intentional about a tax plan.
Yeah, and that's exactly why we wanted to bring on an expert to talk all about taxes. And we thought, what better expert than the relatively new director of tax over at Your Financial Pharmacist, right? The parent of this whole podcast. So we thought we'd bring on Sean Richards, again, the director of tax there, to talk all about tax season and what are some of the tricks and things to be aware of before we get too far down that road.
And Sean obviously knows pharmacists well, being with YFP, and I really appreciate that he's able to demystify some of the frequent misunderstood issues about tax breaks for pharmacists, especially because I'm imagining that a lot of people listening are pharmacists with a W-2 pharmacist job and trying to see, what does real estate have to do with my taxes in this picture? Mm-hmm. So he's able to talk to that kind of scenario and put into perspective some of the tax benefits and how that looks for a lot of pharmacists.
Yeah, and you also had some good points about end of year investing considerations. Again, as we get right to the end of this period, right, the end of 2022, what moves are you making? What moves should you not make? What are things that are, you should be rushing to finish before December, or what could wait till January or beyond, right? Those are things that are important to consider before the end of the year shows up.
Yeah, and kind of with that hat on of that advanced planning and the strategy there, Sean talked about the value of that proactive tax planning versus just the reactive tax compliance work, because I think that scary thing you don't want to hear from a tax professional is, well, it's too late now. You could have done this, but now you're kind of stuck. And those are scary words. And so just the value of talking with somebody proactively rather than just bringing a stack of files in January or February or March to a tax professional, a huge, huge difference there.
Exactly. Well, hopefully, if nothing else, this episode gives you a little understanding of when you might be able to swing the DIY approach and when you might want to call in an expert like Sean or the YFP team. So with that, we'll take you to the episode and hope you guys enjoy. Hey, Sean, welcome to the show.
Thanks for having me, guys. I'm glad to be here and good to kind of meet you guys virtually.
Yeah, this is awesome. I know we've been working together for a while, kind of behind the scenes, interacting a little bit here and there, but it's nice to finally get on the mic, chat a little bit, and get to learn more about what you do here at YFP.
Yeah, absolutely. Same here. I'm excited.
So why don't we jump right in, give everybody a little bit of your background and introduce yourself.
Yep. So I'm Sean Richards. I'm the director of tax for Your Financial Pharmacist. I'm a CPA, so accountant by trade, been a CPA for about 5 years. prior to joining YFP, I actually, in the spirit of the real estate and everything, I used to be at what was at one point the largest REIT, real estate investment trust in the world. I think as of recently, they might be number 2, but it was a company called American Tower. So if you're in that space or you're familiar with not so much, personal real estate, but sort of more on the corporate side, I was there for about 10 years. So there for a while. I went to another company for a brief time after that, and then I joined YFP. So been here for only about 3 months now, but it feels like a while in a good way. Just learning a lot every day, meeting people and everything. It's been awesome. Like I said, I'm a CPA, and I recently got my EA too, which a lot of people aren't familiar with, enrolled agent. So it's an IRS certification. Basically, just allows us to chat with the IRS without them questioning things. I went to a school called Bentley University. So if you're not from the area, you've probably never heard of it. But if you're from my area around Boston, you hopefully have heard of it. It's a business school up here. So I think that's generally the gist of my story.
That's great.
Very good. And I know you tiptoed into it a little bit with the REIT story, but can you tell us a little bit about your real estate background or real estate investing aspirations or anything like that?
Yeah, so myself, aspirations would be a good way to put it. So real estate investment properties, don't currently have any in my name. I just recently purchased my first house with my wife a couple years ago. So that was the big jump in there. And now that we have 11-month old at home, where we've gotten through that piece, and now I can start kind of looking towards myself for the investment properties. But that being said, I have a lot of experience. So a lot of people in my family have. In fact, we actually, my brother-in-law just closed in a place this weekend, so I was talking to him about all that. And then, of course, being the director of tax here, doing a lot of taxes for people who have investment properties, and helping people with their tax planning and all that sort of stuff. So a lot of tangential experience, but I'm excited to learn from you guys to actually jump in myself a little bit. So hopefully this can be a little bit of a trade-off of knowledge.
Yeah, it's a good way to make you a guest and an audience member in the future, right? You can be just like everybody else, waiting to hit that first one. So that's perfect.
Yep, exactly. You guys can tell me if now is the right time. I'm sure that's what everybody's asking, but we can get to that piece later.
I love it.
Yeah. Now, and I know one of the things we talk about is that real estate investing has a lot of different benefits to it. There's the cash flow, there's the appreciation. Hopefully the mortgage is paying down over time if you have a mortgage on it. And then we also throw out tax benefits. And a lot of times when people talk about tax benefits, they say, oh yeah, and there's tax benefits. And then they quickly move to another subject because that feels kind of nebulous to a lot of investors. Clearly that's not to you. So could you expand upon that just a little bit from a big picture standpoint? Why would someone perceive tax benefits from real estate investing?
Sure. It's probably because it's not so much nebulous and more just everybody hates tax, right? I don't think anybody wants to be talking about taxes at any given point in time. So if you can just say benefits and move on quickly, that's good. But no, there's a ton of benefits, tax benefits with real estate investing. So the big thing that everybody likes to throw out there, but it's a valid big thing, is the deduction. So there's a lot of things that you can deduct, but that's another one of those things. I don't want to call it nebulous, but it's something where people sort of throw that around. It's like a magic word. Actually, I was thinking recently the show, I don't know if you guys watch Schitt's Creek, but there's a joke in that where it's just like, oh, it's a write-off. You can write it off. It's a write-off. It's a write-off. That's kind of what everybody says. But it actually is true. When it comes to real estate, a lot of things are deductible. And what I mean by that is you're generating income, and you get taxed on that income at the end of the day. The IRS wants it. Uncle Sam wants their money. And in a lot of different investment vehicles, you don't really have the opportunity to sort of reduce what your gain is or what you're going to end up paying money on, right? So if you're investing in the stock market, you pretty much are just letting your cash sit there. You have a gain, and that's that. On the real estate side, there's a lot of opportunities to, you're doing a lot of work, you're putting a lot of effort in to actually be able to reduce that gain at the end of the day and really get value out of the expenses and the time that you're putting in. So there's all sorts of ones. There's depreciation, there's property tax and insurance, there's maintenance, all those sorts of things. Those are all things that you're going to be doing anyway. But with real estate investing, it gives you the opportunity to actually have that take away from that gain at the end of the day and reduce what you're going to ultimately pay in taxes. So I'd say that's probably the biggest thing. And again, people throw it out all, love to just kind of, it's like a buzzword, but it really is, the deductions are probably the biggest piece.
I love that. And it's a great overview of kind of the basics. I think without getting, because this is a topic that's so huge, right? Obviously it's entire businesses, it's entire careers for people. So we're not trying to answer every question tonight, but I think giving some people a taste of what these actually look like in practice might be helpful. So why don't we dig into just a few of those things you mentioned and get a little more idea of what that looks like. So why don't we start with depreciation? Can you maybe briefly define depreciation from a tax standpoint? What is it? How does it work? Again, very broadly.
That's a fun one. Going to business school, that gets burned into your brain quite a bit. So depreciation is interesting because, a lot of people will say, well, my property is going up in value. How come you're depreciating?
Exactly.
And I think people probably like to think about it like the old, you buy a brand new car, you drive it off the lot and the value goes down right away, right? But that's not the case with the real estate property, or at least you hope it's not. So it's kind of an interesting way that it works with real estate specifically. So depreciation is effectively the IRS or, the accounting board's way of saying you can take a bit of expense for your asset over the course of its life. They don't want you to be able to go in and buy a house or buy a car or buy anything and immediately deduct those expenses. I was just talking about the deductions. They're great for you as a taxpayer, not great for the IRS, obviously, right? So I don't want to say it's a compromise, but they basically say, okay, cool, you're buying this stuff. It's going to have a long life associated with it. We'll let you deduct some of that as an expense, but you have to do it over the life of the asset. So usually it's ratable or straight line even throughout the course of it. But, you have a property and you have your useful life and you're basically just saying, all right, it was $100,000. It's going to last 20 years. You're taking that percentage of it every year for the 20 years to kind of get your expense. It's sort of the IRS's way of matching the revenue with the associated expense too, because the idea is that you're going to be generating revenue over the life of the asset. So you want to be able to match your expenses. It's a principle called the matching principle that comes into play with accounting. But yeah, it's kind of, like I said, I don't want to call it a compromise, but it sort of is a compromise between the taxpayer and the taxing authority.
I think it helps to separate it like you did from the appreciation of the property is one thing, right? The property itself is going up in value, but that's unrelated to the fact that the things in that property are breaking down perceivably over the course of the life of that property. So it's important to keep them separate. I think that helps. Then the other term that I get thrown around in kind of that same message is bonus depreciation. And we've talked a little bit about it on the show in the past, but just again, briefly, like what it sounds better. Like what's a bonus depreciation? How does that work?
Well, it sounds better, but it also just contradicts everything that I just said. So throw all that stuff out the window.
Right.
Bonus depreciation is basically, it's, that compromise I was talking about. It's a recent thing. I think that actually came out for the first time in like 2002 or something like that. But it was basically, every year you probably hear about the government, Congress coming up with new changes to the tax code and everything. This is an example of that where they said, okay, we want to cut small business owners, investors a break and say, if you're going to invest in certain types of property, we'll let you depreciate it right away, or we'll let you depreciate half of it right away, and then you can depreciate the rest of it over the course of time. So it allows people a chance to take that expense deduction right away. The thing with that, though, that you have to kind of keep in mind is that even though you're able to take that expense, you need to have income on the other side to actually offset that expense. So even though it's something where you're like, wow, that sounds great, I get a big deduction this year, if you don't have revenue to offset or to kind of, pick up that expense, it doesn't really do anything for you. It just sort of sits there. You won't lose it, but it'll just kind of perpetually go out until you bring in revenue. So it's a really cool thing, but it's something that you have to sort of, look at your overall tax strategy, look at what bracket you're going to be in this year, next year, whatever, and decide if that's something that makes sense to you.
So I know with an audience of a lot of pharmacists listening to this, I'm imagining the pharmacists are thinking, well, I have a W-2 income. Can't I depreciate this rental property and then not pay taxes on my W-2 salary? But does it work quite that way?
It would be awesome if it did, but of course that would be a little bit too easy, right? So it doesn't work that way. In rental revenue, there's a lot of specifics with it, so I'll kind of be really high level with this. But generally speaking, rental revenue is what we call passive. So it's revenue that you're sort of it's happening on its own. You're not necessarily doing a whole lot with it. When you have these losses on or something like that, and you have W-2 income, you can't just take your losses on this side and offset your W-2, which is active income, the opposite of the passive. You can deduct like $3,000 worth of it a year, But generally speaking, you can really only take those losses on the rental side against your passive income. One thing I know we were talking about depreciation. I just want to kind of go back to that really quickly just to make it clear to folks. So you're mentioning the property value going up. The one thing to keep in mind with depreciation is that that's an expense that you're taking every single year. But what that's doing is it's reducing the base that you have, the cost base in your house. So it's nice that every year you get that, little bit of expense that you can take. But you have to keep in mind that as your value is going up and you go to sell that property in the future, you're ideally going to be selling it at a higher cost. But if you've been taking the depreciation, your base, which I know it doesn't necessarily mean anything to anybody, but that base is what you use to calculate your gain, which does matter to a lot of people.
Yeah.
So if you've been depreciating the asset, your base at the end of the day is going to be less and you might have a bigger gain. So ultimately, you're going to be getting that benefit one way or the other, whether you have a higher gain or lower gain at the end of the day versus the depreciation over the course of time. It's just something that you want to, talk to your tax professional, your CPA, and try to figure out, hey, when does it make sense for me to do this? When does it make sense for me to do that? Just something to keep in mind.
Super great point you just made, right? Talk to your tax professional before you do that stuff, right?
Right.
Ask them what the right time might be for that move, right? Or what are the consequences of this action if I go ahead and sell this, rather than saying, hey, I listed this and we have an offer and it's selling next week. Is that okay? Like, don't do it then. Ask way beforehand. It's going to be a lot better of a conversation.
Yeah, it's an analogy that I like to use a lot. We call it's tax planning versus tax preparation. So tax planning, I like to think of it as a director of a film who can kind of throughout the course of the filming, they can tell the actors to do this or that, and they can change things as they go. Whereas, and actually, we were just talking about it before we started here. I like to say the tax preparation is sort of like the editor, but in this case, like a podcast editor, right? After the podcast is done, they can take it and they can, cut this and that, but the interview is over. There's only so much that can be done. So that's the way I like to think of it, right? Once you get to the end of the year, once you make a decision, there's work that can be done. Your CPA can, file your return to get you the best deductions and everything at the end of the day. But if you work with them before you make those calls, generally you can, get your ducks in a row a little bit better.
I love that analogy. I think that's really spot on. Okay, so then the last question with this depreciation thing, if I'm a pharmacist, we're almost at the end of the year here. This episode's going to go live here in a couple of weeks. We're going to have only a couple of weeks left of the year when it's out and about. Is it worth it to buy something quickly and try to get that depreciation there at the end of the year? Or like you're saying, you're not going to have enough income to offset that is related to that property?
So like I said, it's one of those things where you kind of want to figure out where you land. If you have a bunch of income that you can offset, it might be something where it's worth doing. And the bonus depreciation I was talking about before. So 2017, they had the Tax Cuts and Jobs Act, and that changed the bonus depreciation amount up to 100%. So some of these specific types, it's not a house, but large equipment, vehicles, things like that generally fall into that category. You can take that 100% cost deduction in the first year. That goes away starting next year. It drops 20% every year, I think, until 2027. So if you were to buy something next year, you only have up to 80% of that first year depreciation. So again, it really all depends on your situation. If you have the revenue to offset this year and you're able to take advantage of that, might be something worth considering. Otherwise, maybe not so much.
Great. Love it.
One thing, because I think the last thing anyone wants to hear is their tax professional say, well, it's too late now, but, so to avoid that kind of thing, as we're looking at the end of the year here, if people are looking to maybe buy new appliances or have a roof put on or a furnace or some kind of big expense, is that something that would qualify in the bonus depreciation category? Or those things that are depreciated over different periods of time? And how would someone think about that as they're thinking through, like, well, I have a month left in this year. What kind of things even count in that category?
Yeah, so like I was saying before, the bonus depreciation stuff generally is larger machinery type stuff or equipment, or some vehicles fall into that category. I'm sure some appliances would fall in there too. The IRS has specific guidance on what things are in and what things are out. I think you had mentioned upgrades or improvements. So generally speaking, upgrades and improvements fall under that sort of depreciation thing I was mentioning before, mentioning now. So if it doesn't fall into the bonus depreciation, you're generally over the course of the life, you're taking the piece of it. And it adds to that base of your property that I was talking about before. So that affects like your ultimate gain or loss at the end of the day. If you have other things that aren't so much improvements, but are more maintenance and repairs and everything, those are things that are deductible as you spend them, regardless of, whether it's today or tomorrow. When the cash goes out, that can be done. So if you're looking at it saying, hey, I'm thinking about painting my house, or, doing some things that are more, I like to use the analogy of like, if you can take it with you when you leave, then it's more of like a maintenance type thing, versus if you put something in and it's staying forever, that's more of the improvement. So if you're looking at doing repairs and things like that, definitely if you get that in this year, that's going to count for this year versus next year. So I think those are more of the bigger things to keep in mind as we're getting towards the end of the year.
And then it sounds like too, then from a record keeping standpoint, as you're managing that investment, it becomes really, really crucial to when that receipt comes in or that invoice, you're marking on that this is a repair versus this is, we put in something to upgrade the property, but you're clarifying that nicely for your tax professionals so that they can make sure that gets categorized and maximized at that point in tax prep season, right?
Yeah, I'm laughing because you said it, to do it for your tax professional, because I've had plenty of times where someone just given me like 1,000 receipts and said, hey, I did this. I sold like you said, the house is sold. It's over and done with. Now I got to like figure it out. So we'd have to parse through and say, hey, all right, this was a repair. This wasn't. Now, we will charge for that, but it's nice for your tax professional, but also it's something that you're going to need at the end of the day. I mean, you need to justify all these things. If you're claiming on your tax return, if there's ever an audit or something in the future, or you need to justify, you need to have that stuff. So if you're doing any type of work on your house, whether it's repairs and maintenance, whether it's a big purchase or something, crucial to keep that stuff. I mean, I know keeping paper nowadays stinks. Just, scan it in, put it on a hard drive somewhere and just forget about it. Just make sure that you can go access it later. But record keeping is one of those things that it's like the accounting nerd in me coming out. But in fact, I used to be an auditor too. So that's probably that piece that's like really coming out. But definitely that's the biggest thing I would say is when you're especially getting close to the end of the year, just make sure you keep everything, keep it all.
All right, I want to shift gears a little bit because I've been getting these questions recently, just people talking about it with the change in interest rates, right? Interest rates have been increasing. If you've been living under a rock, we're now sitting at almost 7% for a typical 30-year fixed conventional mortgage, even higher for most investors. How does that work in terms of the tax advantages, right? Because we can deduct mortgage interest. Does that mean that we're getting better in terms of our deductions there? What does that look like?
Yeah, so you just have to keep in mind that there's different rules for your primary residence versus a rental property. In fact, it's actually, I don't want to say it's easier for rental property, but for primary residence, there tends to be more rules around it. Whereas for a rental property, if it's something where you're generating income, any expenses associated with that, generally speaking, are going to be deductible expenses. And one of those is mortgage interest. So yeah, I mean, as much as it stinks that your rates are going up and you're going to be paying more, the interest on those mortgages is a deductible business expense that at the end of the day will reduce your taxable income. So it's definitely a silver lining, I would say, to the rates going up for sure. But yeah, I mean, that's absolutely something that people can take advantage of as part of this whole, I mean, I'm not living under a rock, but I'm trying to hide from it, I would say.
It's reasonable, actually, based on what's going on.
Yeah, I think a lot of people are trying to hide from mortgage rates right now. That may be something that we continue to see change. I don't know if it's going up or down. It's kind of unpredictable. At least from a predictability standpoint, I'm assuming that taxes are a little more predictable into 2023. Do we have some forecast of what's going on in 2023 and what might be changing for real estate investors when it comes to taxes?
Yeah. So one thing, I mean, it definitely, if you've been paying attention to the news, they did bump the standard deduction up. So that isn't as much on the real estate investment side. Definitely is important for your home investment or your home real estate. Like I was just saying, there's different rules for mortgage interest. So if you itemize your deductions now, you're taking your mortgage interest as an itemized deduction. But since they ticked up that standard deduction amount, you might be, closer to the fringe between those two. So another situation where working with your tax professional to figure out if it makes sense to take the standard, to take the itemized, it's always important. The other big stuff on the horizon, again, it's a little bit more on the residential side, but the biggest stuff. So if you heard the new, I think they call it like the Biden tax laws and everything, but the recent Inflation Reduction Act, so that changed quite a bit on the energy and other types of credits for residential. So a lot of changes there. I know I'm actually thinking about getting some skylights put in with solar panels on them. So they have solar built into the skylights. And because of that, they qualify for the solar credit, which is 30% credit. And not to go completely down the tax wormhole right now, but a big distinction I want to make, because a lot of people use these interchangeably, is deductions and credits. Deductions reduce your taxable income at the end of the day. Credits, dollar for dollar, reduce what you actually owe in taxes. So if you owe $1,000 and you have a $500 credit, it's coming right off. So those are big ones to keep in mind. So I mean, people used to use the term that they just changed all of them as part of this new tax law, but the lifetime credit, I can't think of the official word, but where you could, like getting new windows on your house. So there used to be like a $500 lifetime limit on that. That changed to a $1,200 annual credit now. So lots of different opportunities on the energy efficiency side, definitely, especially when it comes to residential properties. But yeah, I mean, I think some of those would apply to investment properties too. But I think as far as just the major sweeping changes that are coming next year, those are probably the biggest ones to highlight, I would say.
I think that helps. And I know this is probably going to have a big Tim Baker, it depends attached to it. But if someone's thinking about selling their house now, right at the end of the year, does it make sense to do it now, or does it make sense to wait until the new year? I mean, are there any advantage that's, sweeping in terms of waiting, or does it not matter?
Well, I joke with Tim Baker that we're going to co-write a book, and it's going to be called It Depends, because it comes up in taxes all the time too. And it's not a cop-out, because it really depends on everybody's individual situation. But so it does depend coming up to the end of the year. I mean, if you sell your house on December 31st and you have a gain on that house, that is a 2022 gain. If you wait until midnight and sell it on 1/1 of 23, that is a 2023 gain. So if you think, oh, I'm going to have like a huge gain, I'm not going to be able to pay this or whatever, I mean, that's something worth considering when you're getting close to the end of the year, that it really is, like a clock strikes midnight kind of situation. One thing to keep in mind with that, though, is that you wouldn't want to necessarily rush that, because I'm sure you've talked about it before, but there's a exclusion when you sell your primary residence. So if people are out there thinking about doing that, it's a $250,000 exclusion for filing single. If you're filing married, double that, $500K. But that requires you to have lived in that property for 2 of the last 5 years. And I know we're getting really specific, but if you're coming down to it and it's only been, 11 or 1 year and 11 months, and you're talking about selling your house, you want to wait until you get to that 2-year mark so you can get the full benefit of that. Unless you're, moving for work or something like that, there's different rules for that. But that's something to keep in mind. I mean, I know it might only apply to a couple listeners on here, but being able to pick up a $250,000 exclusion on a gain of a sale of a house that's huge. A pretty big deal. So we're definitely worth considering that, I would say.
That's awesome.
Yeah, I would imagine it's also a really big deal we talk about house hacking a lot. When someone may live in the house, rent out bedrooms, or live in a duplex, rent out the other side. There's probably situations too where, or a live-in flip, where someone buys a fixer-upper, fixes it up slowly. It sounds like there may be a real tax advantage to fixing it up over the course of 2 years and a day to when you go to sell that primary residence live-in flip then.
Yeah. And the other thing is that you could be in a different tax bracket based on different years too. So, if you're working a job right now, say you're a pharmacist and you have a W-2 job and you're making good money and you're in a higher tax bracket now, and you know that next year you're going to quit that job and start a side business and, do your own thing. You might be kind of eating ramen noodles for a little bit and be in a lower tax bracket. That's something worth considering if you're going to have a large gain and you know that you're going to be in a lower tax bracket in the future, or the flip side, if you know that you're going to get a huge raise next year, you're going to be a higher tax bracket. Again, it's one of those things where it goes back to that whole director versus editor thing. If you can make those decisions ahead of time and really think about it versus, oh, well, I sold a house and, there's only so much you can do at that point. So definitely lots of things to keep in mind.
Yeah, I think that it's, I'm hoping that we're highlighting the value of that director role, because I think that there's a lot that goes into that intentional planning to make sure that you're running your business and running your investing in such a way that you're considering taxes in that. So for that listener out there that's thinking like, well, maybe it's time to stop doing my own taxes and maybe it's time to bring in a tax professional, like how would someone know that they've hit that threshold? And then how can YFP help?
Well, if they're asking the question, they've probably hit the threshold. But if they're beginning to think about it, I mean, even if you're just starting to think, hey, maybe it's time, or, I have a couple different schedules this year I didn't have before, or I'm thinking about doing that, it's worth just reaching out and talking to somebody. I mean, you might talk to an accountant who says, hey, it might seem like a lot, but it's easier for you to do it yourself, or it might not be. But our team here, so we have a lot of different options for whether it's consumer to consumer, consumer to business. But I think in this space, we're talking mostly on the, consumer to consumer sort of individual investor side. So we have a comprehensive tax planning package that we provide that really gets into that director role I was talking about, where you're sitting down multiple points in the year, doing a projection, looking at what you're withholding, what you're expected to owe at the end of the year. That one's actually really great too. If you're also on our sister company, YFP planning side of things, we work with the planners to really look at your financial plan and say, how does this make sense with where you are with taxes? And people are talking about, hey, I want to sell this investment property. I need the cash, but it's also going to be a big tax hit. So, there's a lot of things to consider. But yeah, the team at YFP is certainly well versed in all that stuff. So we're definitely here to help. If you're interested in that, you can reach out to me or go to the website or any of those things.
And I have to say, as someone who is a YFP planning client and a tax client, it's been awesome to see
Totally
that.
Unbiased.
Yeah, completely unbiased, right? That's the whole show, is completely unbiased. No, but truthfully, I mean, like, my wife and I love having that correlation and that connection between the planning side and the tax side, because it lets us make decisions not in a silo, but with everybody involved, right? I can say, hey, we're thinking about buying this house. What does that look like for our financial plan? What does it look like for our tax situation? And you guys get together behind the scenes and then come back and say, okay, here's the answer. And so I love that. And so again, just kudos to you guys and the team. It's been awesome to work with you guys for the past couple of years.
Yeah, I'm glad. I mean, hearing that stuff makes me happy too. So, I mean, that's my goal is to make taxes not painful for people, and hearing that, it's been a good experience for you, just it brings me joy. So working with the planning team is definitely really helpful in that regard. I would say that's probably the biggest piece.
All right, Sean, I want to flip you to our final infusion questions. 3 questions we ask every guest we have on the show. The first one, what's one tangible strategy that you use to make sure that you work on the business, stay working on the business rather than being stuck in the business?
Oh boy, working on the business and not stuck in the business. Well, I mean, one thing is really just thinking about, this goes back to an old job that I used to have, but a boss of mine used to say, we're not saving lives here, right? So even though I do like saving people money and making sure that people are happy and stuff, I always have to just take a step back and just say, like, it's a job, it's work and everything. And I see you have a shirt that says Girl Dad on, and that's 100% what I need to go back to. So even if I'm stuck in the job, I know that might not be exactly where you're going with the question, but I just always have to kind of take a step back and just say, like, no, this is what I'm doing this for. I'm doing it for family and just to keep myself sane.
That's a super important perspective. I think that's easy to lose when we talk about this stuff and you get lost in the money and the minutia, but it's like, okay, but why are you doing this? And what is that why and what's driving it? So that's awesome.
Yep.
Yeah. And I know that you are just starting your real estate investing journey here, but what's one resource that has been most helpful to you in your investing journey? Whether that's a book, a podcast, a person, author, website, what's helped you grow in that area?
Sticking to the tax thing, I actually read a book probably about 3 or 4 months ago. I had it written down just to make sure I didn't mess up the name or anything, but it's called Tax-Free Wealth: How to Build Massive Wealth by Permanently Lowering Your Taxes. Very lengthy, but I always just call it Tax-Free Wealth, by a guy named Tom Wheelwright. So that's a great book because it shifts your perspective. A lot of people hear taxes and they hear all the politics around it, and it sounds like it's just a lot of, mudslinging and people being angry. But when the government makes changes to the tax law, there's a reason behind it. It's not just completely arbitrary, and people might say, oh, it's to make the rich richer or whatever, but usually it's to guide consumers to do something specific. And whether it's a deduction here or it's a credit here, there's a reason behind it. Like I said, like the energy stuff, right? They're trying to incentivize Americans to invest in energy efficient property. So that's a reason why those tax credits exist. And because those tax credits exist, they're there to take advantage of. So it was a really great perspective. I know it's not necessarily specific to real estate investing, but he does get into the tax benefits of real estate. It's just a good way to kind of think, like, why are they doing this and how can it benefit me in the long run?
Great recommendation, and not one that we've had in the past. So that's great.
Nice.
All right. Question 3. What's one piece of advice that you give to a pharmacist that's contemplating a start in real estate investing?
So, I mean, not to go completely back on what I've been saying with this whole thing, but I would just, the number one thing is to really be smart and make sure that anything you're doing with your real estate investing, make sure it matches your other financial strategies. So your overall financial strategy, but obviously, and this is near and dear to me, but your tax strategy too. Like I said, don't just jump into something because you I mean, if something does feel right, you should do it, but make sure that you're considering everything else too. Make sure that all of your different financial strategies are sort of married together. At the end of the day, you can work through divorces, but they're a little uglier, and it's just easier if they're kind of all working together from the get-go, right?
I love it. If people want a director, they want to get in touch with you, how can they learn more about you? How can they get in contact with you?
I know I mentioned the website before and didn't even plug the website. What am I doing? So if you want to get in touch with us at the YFP Tax team, you can get to us. So you can reach out to me directly, Sean at yfptax.com, or you can go to the website, yourfinancialpharmacist.com/tax. I'm going to be on some of the other pods and stuff too. So if you listen to the YFP podcast community, I'm sure you'll be hearing my voice again. So yeah, just keep looking out there, but definitely head to the website. Feel free to shoot me an email directly, and I'll be happy to look into your particular situation.
Awesome. Well, Sean, really appreciate having you on the show today. Appreciate you joining us and sharing your wisdom with us. I'm sure we'll have you back in the future, but again, thank you for your time. It's been awesome.
No, it's been great. I really appreciate it, guys. Great to see you. And yeah, we'll be in touch soon.
Thanks so much.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.